if you can't, there you go. If you can't write fast enough, you can certainly go back to our website and you'll be able to access the webinar. So with that, Alan, thank you very much. And I'm going to turn it over to you.
Kathy, thank you for those kind words, but it's attorney to attorney. Do they count if it's two attorneys talking about each other? I think you're terrific as well. And I certainly enjoy the opportunity to speak to the Agency 100. And thank you for spending some time with me today. What I want to do is go through some slides, and it's just that it's easy to keep track of where we're going to go. So I think the starting is, I'm old, I'm 65, but I also have a son in college, so I'll be in this chair for at least 10 more years. But that gives me some history. And what I would say is estate taxes come and go. The exemption was 500,000. Now it's 11.7. And January 1st, it's going to be 12,060,000. But just as Congress has allowed it to go 12 million, Congress can roll it back to 500,000. So when I'm talking to clients, I don't talk about estate taxes first. I talk about asset protection first, because everybody gets that. If you're talking to the first generation who has or has created the wealth, they're not that concerned about their own asset protection typically, because if you think about what's likely to happen, taxes, well, they pay their taxes annually, but a creditor suing them because they broke a contract, not that likely. A creditor suing them because sadly they were in an auto accident they created, not that likely. But what are the big creditors? The big creditors are potentially estate taxes at death and divorce. And so I talk to them in terms of setting up a trust that is going to last for 4 or more generations. And I ask the question, is anybody ever going to get divorced in the next 4 generations? And would you like to make sure that all the family wealth that you and your spouse have accumulated is going to be exempt from any attack of any divorcing spouse for the next 4 generations? It's longer than that, but 4 is what I talk about. So let's just do basics. I'm talking about what I refer to as an irrevocable gift trust, a trust that is irrevocable as to the person who creates it and the person who funds it with a gift, a donation or a donor. On the other side of that equation is the trustee and the beneficiary. And although it's irrevocable as to the grantor, I'm sorry, let me use the word founder for now, it is completely flexible as to the beneficiaries and the trustees. So over that 4 generation, I expect this trust is going to get rewritten many times. So that is the best asset protection available under American law. It's available in all 50 states. It comes from Old English law, and I know that it works because it's worked for the last 400 years. I then say, oh, by the way, the reason the asset protection works is because you don't own it anymore. A trust now owns it. And guess what? The estate tax only applies to assets that you own in your own name. So guess what? As soon as you solve the asset protection for yourself and the next 3 generations, you automatically, without doing anything else, solve the estate tax. So that just takes the estate tax off the table. Now, estate taxes are still important because we're going to talk about different strategies for different levels of wealth, but I find that everyone will talk to me about asset protection. And I have the conclusion that if I start out talking about estate taxes, not everybody believes they have an estate tax problem. So let's talk about where we are in terms of tax changes. The House Ways and Means Committee in September gave us a tax bill that was scary. It would cut the exemption for gift and estate taxes in half. That's something that's going to happen automatically under current law at the end of 25, but that would have gotten accelerated to January 1, 2022. That is not in the version of the tax bill that was voted on by the House in November. The other were some really unfriendly rules about grantor trusts. So because I want to leave you with the message that even if the law changes on grantor trusts, we all will be fine, I'm going to spend some time with that. But let's now take the rest of the process. The House is finished. Let's call that step one. The Senate Finance Committee and the Senate have not voted on anything. So we do not, you can read every day about negotiations, but we actually have no text out of the Senate. And when the Senate has text, that text has to be reconciled with the House text. They both have to vote. Then it goes to President Biden for signing. So how many people think we don't have enough business days left in 2021 to get a tax bill? I think there's a decent chance we don't get a tax bill this year at all. I think there's a decent chance that we don't get any bad provisions inserted back in at the last minute. But here's what I know, and here's what I'm doing with my clients. What I'm saying to my clients is, I absolutely know what the law is today. So if you're ready to complete a transaction, we're going to complete it today, because then we know the answer. So let's focus on gift tax. So that's $11.7 million per person, double that per couple. That's easy to do. Let's do the next step, which is grantor trusts. A grantor trust is a trust where the founder has on purpose reserved certain rights. And let me use my favorite one. My favorite one is the ability to swap assets or substitute assets of equal amount. And we're actually going to look at that text in a minute so you can focus on that. And even under the ugly proposal in September, it said Grantor Trust established and funded in 2021 was going to be grandfathered. Terrific. So let's go out and set up as many grantor trusts as we want, as we can. I'm old enough to remember 1986 when the very first time there was something called the generation skipping transfer tax. Guess what one of the most valuable things is right now? It's an irrevocable gift trust set up prior to 1986, which is exempt for all time because it was entered into before the law changed in 1986. If we get a grantor trust change, it's going to be the same thing. The best thing anyone could own would be a grandfathered grantor trust. Now, they can't make any new gifts to it. They can't make any new sales to it, but it will be up and running for as long as that family maintains those assets. Okay, so number one, my clients are closing transactions, funding grantor trusts right up until 12/31/2021. The law has not changed. I think it's impossible for it to change this year. So that's what we're doing. Second, let's just have the conversation. Let's say the law does change in January. And I've had some insurance agents, and I'm very respectful of their concerns, saying, doesn't that mean we're all out of business? The answer is no, it's absolutely, you're not out of business. First, non-grantor trusts work great. So there are clients of mine who set those up. The typical is sibling for sibling, sister for sister, brother for sister. When they set up trusts for each other, they don't want to pay each other's income tax. So those are non-grantor trusts to start with. So let's just talk about the difference between grantor trust, non-grantor trust. Grantor trust, the founder pays the income tax no matter what happens. Non-grantor trust, the trust itself is an income tax allocator. If the trustee retains profits, the trustee pays the tax. If the trustee distributes profits, then the trustee doesn't pay the tax. The beneficiary who received the cash or property equal to the profits pays the tax. Income tax allocator. You can put it at the trust level. You can put it at the beneficiary level. So let's first talk about what if you have a grantor trust. The law has changed. Remember, the law has not changed, and there's not currently any proposal to change, but let's just talk through it. I'm going to do this quickly. How would we have solved that problem if we got that problem? Number one, non-grantor trusts are fine. So my first is switch off. Everything I write has this extra provision, specifically either the right to substitute or give the trustee the power to add beneficiaries. Those are the two most popular. Most of those can be released or renounced in writing. We call that switching off. You switch off the grantor trust, you default to the standard, which is a non-grantor trust. Fine. Second, for some reason, you are looking at the document, you don't think that'll work, but you still want to be a non-grantor trust. Well, most trust agreements give the trustee the power to merge two trusts that are for the same beneficiaries but have different administrative provisions. Or there's something called decanting. Many states have something called decanting, which is very similar, which is you create a new trust and decant or pour over the assets out of the old trust into the new trust. In both cases, I'm starting with a grantor trust agreement because it has these special provisions. I write a brand new trust agreement that doesn't have those trust agreements. I merge or decant the assets over. Now the assets are inside my non-grantor trust. Okay. Again, the proposal was you are in trouble if you make a new gift or make a new sale to a grantor trust. There wasn't anything in there about loans. Loans are okay. So life insurance inside a trust, it's a grantor trust. I don't mind it staying a grantor trust. I can't make any new gifts. I can't make any new sales. Hey, I can make loans. Terrific. Anyone on the phone or on the video ever heard of something called split dollar? It's only been around since the 1950s. And it's a way for a trust to finance life insurance by borrowing money from a family member or a family company or another family trust. And so that is actually a form of financing of life insurance. And I can reassure you, split dollar is alive and well in 2021. We've actually got a massive split dollar program to finish before year end. If you don't want to borrow within the family, borrow it commercially. My understanding from Agency One is premium finance lenders are out there with very large amounts available and very reasonable rates. So you have not, the founder has not made a new gift, has not made a new sale. We leave the life insurance right where it is. What's my last point? My last point is there is a rule in the Internal Revenue Code that says if a trust is permitted to use income to pay premiums, then it's a grantor trust, whether you want it to be a grantor trust or not. The IRS has not pursued that aggressively, but those of us who read text really carefully are a bit concerned that if I'm trying to set up a trust and I want it to be a non-grantor trust, if I have in that trust insurance on the founder, even though I think I've written my trust agreement carefully, I think what I would do is I would not have the trust itself own the life insurance. Now, how do I solve that? As easy as can be. I just have the insurance in a simple two-member LLC. You know, let's have 99% of that be owned by the trust that I want to be a non-grantor trust, and then have, you know, unlimited amounts can be gifted to this non-grantor trust. Unlimited amounts can be contributed from the non-grantor trust upstream to the LLC. LLC pays the premiums. There's no question I'm not a grantor trust, and I don't have to think about those potential rules. So the point of this segment was really smart people, and Agency One are smart persons. I will include myself in that group. Whatever the changes in law are, we will address them. The world is not coming to an end. Everybody will still be doing business if we have new rules. Just so you see it in print, and Agency One is going to make these available to anyone. The first is my preferred language for I want this to be a grantor trust. This is a short version of it. And there it is. It says, I intend to be the grantor, and during my lifetime, I can substitute assets of equal value. Couldn't it be more clear? I write non-grantor trust. If that's the intent, I say, I am not the grantor, don't tax me. And then I usually put in some restrictions. You can't do transactions for less than adequate consideration. You can't borrow without adequate interest or security. You can't use trust income to pay premiums, and you can't substitute assets. So that's very clear about what it is. I'm a grantor trust or a non-grantor trust. Okay. Let's talk about non-grantor trusts, and this is from a series of questions I've got, and I've consolidated them a little bit. And the point of that is, doesn't every grantor trust turn into a non-grantor trust at the death of the founder? Yes, it does. So we all need to be familiar with non-grantor trusts and how they operate, because kind of the big sweep of irrevocable gift trusts as grantor trusts has really been within the last 20 years. So we don't have this huge number of non-grantor trusts yet, but it's coming, and it's coming quickly. My oldest client right now is 105. And I've got a bunch of hundreds and 99s and 98. So I'm sorry to say, but over the next 10 years, these grantor trusts are going to be turning into non-grantor trusts. So let's just spend a second on non-grantor trusts. Remember, I said it was an income tax allocator, but Congress has made it, and the tax code has made it very unfriendly to accumulate income in a non-grantor trust. The current maximum tax rate for individuals, estates, and trusts, everybody gets the same rate, but the point at which you pay that maximum rate is hugely different. Married couple, it's something over $600,000. I'm going to look at my cheat sheet. For a trust, it's $13,050, 13050. So that's essentially a flat rate of 37%. So what do my clients who have non-grantor trusts do? They sweep the income out every year, because somewhere in, typically these are trusts that have multiple beneficiaries, children, grandchildren, great-grandchildren, and I can put assets anywhere I want it. I can distribute to any one or more of those beneficiaries. And guess what? There's a whole bunch of them that are at tax rates less than 37%. So I don't have any problem moving it out of the trust into the beneficiary's hands. One of the unfriendly things that's not going to apply to a lot of people, but is going to potentially apply to trusts if people don't keep their eye on the ball, is what's called the Sur Tax. There's a Sur Tax of 5% if you make this many million, and another 3% if you make a huge amount. But for trust, the 5% Sur Tax applies after $200,000 of income, and the additional 3% for a total of 8% over $500,000 of income. So nobody who's minding the store should be accumulating $200,000 in a non-grantor trust, because otherwise you've voluntarily paid the Sur Tax. This ties into the first set of questions. And the first set of questions is, why life insurance inside a trust? Didn't we just answer that question? What is the single best investment that is income tax free, that is available to any buyer, and trust being a buyer? The answer is life insurance. So if you actually want to accumulate that income, you don't want to pay it out, you want a reasonable rate of return, you don't want to be stuck with municipal bond rate of return, life insurance should be an investment component, I believe, of every significant grantor trust. Okay, so we've just decided there's a huge income tax reason to have this life insurance in my non-grantor trust. Well, let's talk about what the ancillary issues are. Remember, I said four generations of beneficiary. This is a huge change to 400 years of trust law. Until 25 years ago, there was no such thing as a 3-generation trust. Every generation was lives in being plus 21. So everybody died, you got to close it up in 21 years, but that's essentially 2 generations. Now I've got Georgia, Florida, 360 years, Nevada, 1,000 years, Illinois, unlimited, as long as there's an American legal system. So I use 4 generations because it's easy, but potentially we're going even farther than that. So what asset can you buy today that will refill the well that gets emptied with distributions to generation next? So let's say I've got a trust, the beneficiaries of which are generation 2. They are taking distributions out of the trust, but the trust is supposed to be here for 3 and 4. What happens if I pick a number, 10% of the assets and invest it in life insurance on generation 2? So at the death of generation 2, I replenish the well for generation 3. I then insure generation 3 for generation 4. Obviously, none of us on the call are here working for generation 4, but the concept and the, I'll call it the discipline to do that, I think is coming in the trust industry, and I encourage the life insurance industry to be at the forefront of educating families, because there are corporate trust companies, very limited in what they feel like they can do. They don't like getting sued. So, and I actually I don't think I have a single trust right now with a corporate trustee. Sometimes we hire corporate trustees to do work on a fee, but all of my trustees are human trustees. So you're talking to families and their attorneys and their accountants and financial advisors who are acting as trustee. And the idea is, how do you make sure you have wealth generation after generation? I think putting a percentage of the investments in life insurance accomplishes that. The next piece is, okay, I'm buying life insurance just like I'm buying stock. Am I going to buy one policy? I don't think so. I don't give investment advice, but I read a lot about diversification. So I think you need a diversified portfolio of life insurance. I think you insure all of generation 2 and all of generation 3 as soon as they're old enough to insure. I'll insure the beneficiaries and their spouses. Even though their spouses aren't beneficiaries, they're still insurable interest. I can still do that. And this is now beyond my expertise, but you're going to buy from a number of different insurance companies for diversification, and you might even buy different kinds of life insurance. Maybe it's permanent insurance on the older people, some term insurance convertible at, age 30 on the younger. But that's the point of a diversified portfolio of life insurance, which accomplishes 2 hugely important missions for these multiple generation trusts. Number 1, it helps to solve the income tax problem that's going to hit these non-grantor trusts. Either they were non-grantor trusts to start out, or they became non-grantor trusts when generation 1 died. And number 2, we're going to fill up the pot generation after generation, and we're going to have the discipline that when generation 2 is gone, we've insured generation 3 for 4, 4 for 5, as many generations as this can go. So my sum is life insurance, let me say it this way. I'm old enough to remember when the insurance sale was, here's how much estate tax you're going to pay. You need to buy insurance to cover that. You'll notice that in all the discussion about why this family and these trusts should buy life insurance, I didn't mention the word estate tax one time, partly because it's not relevant to that many families, but most importantly is I don't find it a really good reason that people get get excited about. But I think people get excited about protecting their assets. I think they get excited about thinking about their legacy, and that a trust with their name on it, or of which they're the founder, is out there. My joke is, if this trust is big enough, generation 4 is going to put a statue up in the backyard to you because you did just such a wonderful thing for the family. I think they get excited about that, and I think they get excited about not paying income tax currently. I think people do get excited about that. So that's our backdrop that against which we're now talking to clients. It's December 2021. Most of the clients I'm closing up with this, we've been at it for 6 months, because I'm very respectful that when I ask you to create an irrevocable gift trust for the founder, and the founders may make a gift and can never again touch that trust, that's a big deal. And even though on the other side, the trustees and the beneficiaries have a lot of flexibility, that's a big deal. So we don't rush these, we do these in a very appropriate way. So my key tools are going to be irrevocable gift trusts, which are on purpose Grantor Trusts, and something called a management LLC that we'll discuss in a minute. And we're going to talk about less than 5, 5 to 10, 10 to 20, and 20 or more. I'm going to start out by talking about the tools I use for the 20 or more, because they have and use the most tools. And then we're going to circle back and say, now let's talk about people with less wealth. Are those tools appropriate for them or not? So I'm stuck with SLAT, Spousal Lifetime Access Trust. I wish I could kick in the shins whoever invented that label, because I hate it. But you hear it enough and you see it enough that I will admit that I am doing spouse for spouse trusts that are probably appropriately referred to as spousal lifetime access trust. There is something from the U.S. tax court called the reciprocal trust doctrine. The reciprocal trust doctrine says if two people make gifts for each other and the trusts are identical down to the comma, then the IRS gets to ignore them. So we're going to have some differences between the trusts. Because these are grantor trusts, you can make a gift up to the amount of your gift tax exemption. You can make unlimited amount of sales. So I like a 10-to-1 rule. I don't like to sell more than 9 times or 10 times what I'll call the seed or the initial gift. But you can see that ends up being a rather substantial amount. So John and Jane make combined gifts of $23 million and then turn around and sell 220 round up. So this works for anybody with $250 million or less who wants to use this technique. Obviously, we don't meet very many of those people. First difference, one spouse is going to be the only current beneficiary of a trust. The other spouse is going to be the beneficiary with children, grandchildren, all descendants. Second change is one trust is going to divide into trust for children at the death of the spouse. The other is going to divide into trust for children at the death of the second to die of husband and wife, both spouses. I've got some other differences, but let's focus on those as being important. So in my initial meeting with Jane and John, I had to ask the uncomfortable question, is there something to indicate who would die first? And if there's no health problems and they're approximately the same age, we come to the conclusion that probably John's dying first and Jane's dying second. So that means Jane gets the position as the single beneficiary, and the Jane Dynasty Trust divides at her death. And the Family Dynasty Trust, that's John and children and grandchildren, and that one divides at the death of the second to die of John and Jane, which is, in my example, Jane. So both of these trusts divide at the same point in time, Jane's death, and that means that we can combine them and divide them into trusts just one time, one trust per child. And the power of what John and Jane did was, of course, it was terrific that they got asset protection for their up to 23 million. But more importantly, they got asset protection for 100% of the growth on their 23 million, and they got 100% of the growth on everything they sold over 23 million. So the amount of money that is now asset protected for the next 4 generations obviously is big and growing. John and Jane have automatically solved the asset protection problem for each of the next generation. So let me be Alan and I'm John and Jane's kids. At the death of Jane, in my example, second to die, I got a trust with my name on it. And if I walked into an asset protection or an estate planning or a tax lawyer and said, hey, I just got this big inheritance and I want to make sure my wife can't take it and I want to make sure I never pay estate tax. If that person is well-versed, they're going to say, done. John and Jane did that for you in 2021. They have handed you at Jane's death a trust that can never be touched by creditors, including a divorcing spouse, and can never be subject to estate tax at your death or the death of your children or grandchildren. You have to do nothing except run this trust. So it's very powerful that John and Jane are doing it today, but this really is a forward-looking plan. So if I had a suggestion to people who sell life insurance, and I hope you all make a lot more money than I do, so who am I to give suggestions, is to try to get people to focus on a longer time frame. You are creating a financial legacy that isn't just now, and isn't just your kids, and maybe not even those grandkids that you have met and are, in their teens, but you need to think about this is going even farther than that. Okay, switching gears, management LLC. Those of you who are a little bit older remember the flurry of family limited partnerships. We set up family limited partnerships and stuffed them full of whatever assets we wanted to protect from creditors. But what we were really going for were discounts. We were looking for gift tax valuation discounts. Well, at 23 million, and I can sell 10 times that, the whole valuation discount game is not nearly as important as it used to be. So I've really refocused what used to be called the family limited partnership. I now use LLCs because they're simpler. They don't need a general partner. They're the simplest form of business organization. They're available in all 50 states. And I'm really using them for a different purpose. And the purpose is whatever the list of things that John and Jane want to give to this asset protection program, if I just make gifts directly into the trust, and if they own everything 50-50, I got to put half of every asset in Trust A and half of every asset in Trust B, and managing those with two owners is annoying. So I'm going to put all of it into an LLC, and then I'm going to give half of the LLC. That's going to solve my problem on how I manage that. I'm also thinking about reporting. When John and Jane are done with this in 2022, by October 15th, 2022, they're going to file a gift tax return. Rather than having a gift tax return, let's say they have 22 assets, instead of having a list of half of 22 assets on one gift tax return, half of 22 assets on the other gift tax return, I have a simple, it says, my interest in John and Jane Family LLC. Sign John. My interest in John and Jane LLC. Sign Jane. That's it. It's the simplest, skinniest looking gift tax return. And all I have to do is attach a copy of the trust and a copy of a valuation report that says 50% of John and Jane Company LLC is worth X dollars. We believe there's almost no or very few humans left to look at gift tax returns. You've read about how the IRS budget has been strangled. Gift and estate tax agents are the only ones who have to have law degrees. So there aren't that many of them to start with. And I don't know many lawyers with law degrees who say, gee, I want to go work for estate and gift with the IRS. So we don't expect, I have not had a single gift tax audit in over 5 years. So we don't expect it, but we still plan for it. Okay, so let's just walk through the transaction. John and Jane each create the trust for each other with the differences we described. They create in the state of their choice, typically their home state. I'm calling it Client Management LLC. They then take whatever that big stack of assets that they want to protect and stuff them into Client Management LLC. And then they each give his or her half of Client Management LLC to his or her respective trust. Simple transaction, simple gift tax return. I also solved a problem that you may have identified. Remember that the Jane Dynasty Trust, the only beneficiary of that is Jane. The Family Dynasty Trust, the beneficiary of that is John. And the co-managers up here, Client Management LLC, are John and Jane. So while both of them are living, both of them have access to 100% of the assets. And if John dies first, we expect that these two will divide to trusts. But at the death of either John or Jane, what happened to the access? If I put the assets directly in here at the death of the first spouse to die, the other spouse just lost access to half of the trust. Half of the assets that are in the trust are in the other trust. But look what I've done up here. Let's have poor John die. Okay, Jane is still the beneficiary of this trust. Jane is not the beneficiary of this trust. Oh, wait. Jane is now the only manager of Client Management LLC. as the CEO of the LLC, she's entitled to salary bonuses, company car, life insurance program, health insurance program, unlimited loans. She still has access to all the assets, even though half of them on paper are now owned by a trust of which she is not the beneficiary. So the client management LLC solves my problem to how does the surviving spouse still have access to 100% of the assets, even though for gift tax purposes, I had to give half of those assets away. This is really an important slide for me. And you know, I'm only going to live to 100, so I'm not going to see whether it's as successful as I hope it is over 4 generations. But I'm a huge proponent of education, education, education. I think it's really unfair to expect a future generation to inherit both the right and responsibility to significant assets or a family company or, you know, family compound, some special land or a, you know, lake house or whatever it is, without the education to do a good job of managing it. So the last thing that is important to me about the client management LLC is at an appropriate age, and every family decides that. It's almost certainly out of college. You know, maybe it's not till you have a successful job or your own business. Maybe it's not until you get married. Maybe it's not until you have kids. But whatever that age is, I want the kids to become officers and maybe even owners of 0.5% of Client Management LLC. And I want them to come to the quarterly meetings. And I want John and Jane to teach them how to be good stewards of this family wealth so that Client Management LLC is still operating 4 generations from now. A couple of minor things. Client Management LLC is an LLC electing to be a partnership. It is a for-profit partnership, and it can deduct all the business expenses that any other business can deduct, as long as it is an active trader business. So I'm picturing Client Management LLC. It's got stocks and bonds and cash and some rental properties and some REITs and, you know, a long list. I want a diversified, obviously life insurance, all kinds of different life insurance on all lives of the members of the family. And there are quarterly meetings in which all of these investments are reviewed. Investments are frequently moved around. Things are bought, things are sold. Okay, that's an active trader business. That's entitled to deduct all business expenses, like an annual meeting where all the family's expenses are deductible at the LLC level. Nice. Please be reasonable. Let's do it in the continental US. Don't tell me that, you know, you held it in Dubai. I don't think the IRS is going to think that's appropriate unless you're doing business in Dubai. Also, younger people, maybe they are, for whatever reason, not working, and yet you would like to get them started on their own employee benefits. You simply, let's pick on Bob. Bob doesn't currently, you know, Bob's self-employed, business isn't successful yet, and he gets a job. The job is, we're thinking about investing in this apartment building at so-and-so location. Get in your car, drive down there, look at it, go down, search the records, interview the tenants, and then come back and write a report and present it at the next quarterly meeting to the board of managers of the Client Management LLC. So we decide whether or not we're going to invest in this. And for that, we're going to write you a $10,000 check as a consulting fee. Congratulations. Guess what? Bob just got $10,000 that he can put in an IRA because that's self-employment income. And he now has something that he can get started, even though he doesn't yet have a successful business, even though he's not working at a job with a W-2. So to me, the Client Management LLC for families with larger wealth are really, really important. And I think are going to be, oh, I'm sorry, I left one out. Gifts to charity. Earlier in my career, I set up a lot of private foundations. I am really soured on private foundations. They are difficult to run. They're expensive to run. The annual accounting is annoying. The state filings are annoying. So I have switched over to donor advised funds and client management LLCs. Client management LLC, for-profit partnership, it can make gifts to charity. And a donation by an LLC is completely deductible. It flows down to the individuals. That's where the cash is. That's where the charitable contributions are made. So I think that these LLCs, these family LLCs, are going to be really important in helping John and Jane communicate the skills that the next generations need, and to also perpetuate the legacy of the two of them. Okay, so let's come down and do our case studies. We're going to do married first, and we're going to do single second. So far we've been talking about the 20 million or more. So definitely I'm doing a spouse for spouse trust with the differences we've talked about. And definitely I'm going to need a management LLC. The management LLC is really important to deal with what is probably a long list of assets, what I call a complex balance sheet, and also solves the problem of the surviving spouse having access to 100% of the money. Okay, next category, 10 to 20. 10 to 20 is a little tricky for me, and I have to ask the question, are they likely to grow or are they likely to shrink? If they're going to grow, then it looks to me like they need to be treated more like the 20 or more. They definitely need the 2 irrevocable gift trusts. And depending on how complex their balance sheet is, they may want a management LLC. 5 to 10. 5 to 10, if we get the reduction, it's 6 apiece, a total of 12. Well, 10's going to grow. 10's not going to be stagnant over the lifetime of John and Jane. So I still need my 2 irrevocable gift trusts. I am unlikely to do a management LLC. No offense, but if you've only got 5 to 10 million, you're probably not running a company. You probably don't have 4 real estate LLCs. So you're not that sophisticated in business, and asking you to run management LLC, which is a real business, I'm unlikely to do that. Less than five, I am not going to do anything. I am going to say, even if your 5 doubles to 10, you're still under the 12. You need the basic estate plan that everyone needs: will, trust, powers of attorney for healthcare and property. But there's not, but unless you're telling me there's something going on, there's some growth aspect. And I'll say, I love my clients, but somehow they completely miss the memo that for estate tax purposes, it's the death benefit of life insurance. So you come in and yet someone says, oh, I'm only worth $4 million. I said, well, that's terrific. You got any life insurance? Oh yeah, I got 5 million on me and 5 million on my wife. Sorry, for estate tax purposes, you're not 4 million, you're 14 million. And no offense, but you just completely missed the memo that you've got a plan for that. So in my numbers, I am including the death benefit of life insurance. I'm focusing on that you've got to take care of that as well. I'm going to pause there, and I'm going to ask Kathy something that's important that we should talk about now before we launch into how single people are different.
There were a number of questions that came in that are applicable to what you just went over. So
okay,
perhaps we could address them now. So this slide it is extremely helpful to us, and I think to most of the folks on the phone. But some questions came in regarding, well, what about the people that really have much more than 20 million? Is there a difference between planning for 20 million or 200 million or 2 billion? What are the different considerations that you're thinking about? And then the other question, which tied right into that, was if you're entering into a planning conversation with a family that's worth 50 million, how does that conversation start? So we're talking about, let's go above the 20 million.
Right. Okay. So I could have written on line 1, 20 million to 10 billion, because the number is the same. I'm joking about 10 million, and here's why I'm joking. A individual can only give 11.7. Husband and wife can only give 23.4. And I will only let them sell 10 times that. So let's say we've covered the first, call it 260 million. So from 20 to 260 million, you are looking at exactly what we do. As soon as we're done with 260 million, you then have to dig out all the tricks that we used in the early 90s when the exemption was growing from 5,000 to a million to 2 million, and people had big wealth. And those are things like grantor retained annuity trusts, where you make a gift and over a 3-year period, you take back a little bit and then all the growth moves on. Residential trust, retained residential trust, where you put a home in a trust, you use it for a number of years. At the end of the years, gift tax free, it moves on. For older people, I had huge success with private annuities. So you look at the IRS table and the table says this person's going to live X number of years. You think your client will live less. The table is set at, basically the AFR, I'll simplify it, which is 1% and change. You know the assets are going to make 12%. So the senior generation sells the assets to the junior generation in return for a series of payments at AFR until death. And then that annuity cancels at death. All the assets belong to the second generation. So once you're over 260, we have techniques. That are tried and true. It's just we haven't needed to use them since the 1990s. So that's that group. For someone who is at 50 million, because take the 50 million and knock off 10 to keep it simple and say you've got 40 times 40% estate tax is $16 million. That is now a number that's going to make somebody's eyes pop. And so, I'm sorry, 20, it should be 12 million. You can say to that group, if you do nothing, you are giving away $12 million today, and that number is increasing every day that your wealth grows and you do no planning. And you can make that number go to zero. So let's remind everybody what the zero is. And the zero is, in my example, real quick, there were tax court cases where someone gave everything they owned to irrevocable gift trusts and family limited partnerships. And then guess what really happened? They kept dipping back in for their living expenses. So the IRS caught them and said, aha, this was never legitimate because you still retain the right to literally use the partnership to buy your groceries. That's the background. So my rule is everybody has to keep something significant. So let's say in my example, husband and wife kept 10, they moved 40. I'm going to round it off and say we did a $20 million gift and a $20 million sale. So that means they still got a $20 million note. But I've got $40 million of assets that are now going to, let's say, double, 80. It would be very rational for Jane and John to say, 80 is enough for my kids. I'm going to say that again. 80 is enough for my kids. They don't need any more. So I'm going to do one of two things. Either the 30 I'm retained, I'm going to give to a donor advised fund that the family can use for their gifts over the next 50 years or more, and stop. So the 80 went tax-free, asset protected to generations 2, 3, 4. Everything else went to charity because they decided the 80 was enough. The alternative is still give the 30 to charity, but Kathy, how much life insurance am I going to buy? I'm going to buy 30. So it's the 30 assets that went in. It's the 80 assets that growth. It's the 30 in life insurance. 100% of the assets, 30 that in my example were retained, went to a donor advised fund. And guess what? No matter what the IRS does, what's the estate tax for this family? It's 0, 0, and 0 because it all went to charity. So you would say nobody would do that. In the last 18 months, my 3 wealthiest families, 1 billionaire, all switched to this program. They all switched to, Alan, we've been working with you for 30 years. We are wonderfully successful. Our kids have now more money than can be spent in 5 generations. That's enough. It's time to turn our attention to charity. And of course, there's life insurance planning involved. So at the 50 million, it is a different conversation because 0 to 20, I haven't talked about charity unless they bring it up. But at 50 or more, we start talking about how much is enough for your kids. And as to the balance, would you rather give it to charity or would you rather give it to your kids? And I said donor advised fund to keep it simple. Most of the people on this call have heard of charitable lead trusts. And that's just, to me, that's just a long-winded version of donor advised fund because it's still a 0 on the estate tax return, but it means that the kids get everything left at the end of 20 years. So to me, that's just a version. So let's just call it charitable planning. So the over 50 is 2 irrevocable gift trusts, spouse for spouse management, LLC, add charitable planning at death, add some massive life insurance if I have not been able to convince you that it needs to be part of your diversified portfolio of assets anyway.
Thank you, Alan. That was terrific. Now, let's not forget the single folks out there because you were going to pivot to that. And I know that we're at the top of the hour. So
this will just take, it'll take a minute and everybody's going to get these slides and you're going to hear verbally, but you are not going to read the word Grantor Beneficiary Trust. The Internal Revenue Code says if someone has a right to withdraw assets out of a trust and that person is a beneficiary, the trust becomes a grantor trust to that beneficiary if there are no other retained rights in the trust that aim back at the founder. So I have no question that that works. The initial gift, in my example, it's called number 2, family member for client. That could be mom or dad or brother or sister, creates the trust and funds it with $5,000. Remember our 5N5 rule. If you have a right to withdraw, the smaller of $5,000 or the greater of $5,000 or 5% of the assets, and that right lapses, that was a gimme, that's a freebie, just like an annual exclusion gift, nothing happened. So the 5,000 goes in, there's a right of withdrawal to the beneficiary, the right lapses, that's a non-taxable event. I now have a beneficiary grantor trust. Terrific. Is this a trust that has been around for 400 years? No, this is an idea that we've only had for a couple of decades. Does it technically work? Yes. Has the IRS gotten around to audit 50 of them? As far as I know, no. And how much money do most people sell into a trust? Do they sell 10 times 5 or 50,000? No, they sell 5 million or 10 million. So full disclosure for my single clients, I took 20 and divided by 2, who have 10 or more, they need more coverage than just a gift. And I give them a beneficiary grantor trust so that they make a gift to the trust for their descendants of 10, and then they make a sale to the trust of which they are the beneficiary, co-trustee, investment advisor of another 10. Does it make me nervous? Yes, it does, because I'm selling more than 10 times the value of the trust. And that was my safe harbor when I had a husband and wife. Am I doing it? Yes. Am I disclosing my discomfort? Yes. And I'm sure it will all be fine, but that's why you're not going to see it written. Now think about how important that management LLC is, because when my client Jane creates this gift trust for her descendants, She can't have anything to do with it. She doesn't have a friendly spouse over there. She's not ready for her kids to take over the money. So it's really critically important that there's a management LLC. So if we go back to the earlier slide, it's the same, that there's a management LLC. Here's the trust of which Jane is the grantor. This is a beneficiary. Here's where the family is. From day one, she has no rights over here. So that's why it's so important that she have a management LLC so that she continues to control those assets. 5 to 10 million. Again, at this point, I'm not giving that much away. You know, so if you're worth $10 million, you're keeping 2 and you're doing 4 for your kids and 4 for yourself. I don't think you really need the access to 4. If you can't limp along on 6, I don't understand it, but I am still doing the Grantor Beneficiary Trust because she wanted to give away 8. She wanted 8 out of her estate, all the growth on 8 out of her estate, but she wasn't willing to give all 8 to the kids. So 4 for the kids, 4 for herself. Again, once I'm back to less than 5, I'm not doing a trust at all, an irrevocable gift trust, or a family member for client trust, also known as a grantor beneficiary trust, unless there's something special, an asset that's going to blow up in value, a family compound that's so important it needs to be protected for 4 generations. So all the same tools, but add the beneficiary grantor trust when I have a high net worth single person. And again, Grantor Trust, very important. We are going to do as many as we possibly can in 2021. And if the law hasn't changed in 2022, we'll keep doing them. If the law changes in 2022, we will pivot. We'll start setting up brand new non-grantor trusts. But boy, I'm not going to let a client close a grandfathered grantor trust after a law change without a lot of conversations, because that's going to be a very valuable thing for 4 generations of this family.
We have that was great. Do you have time to answer a few questions that have come in?
Yes, I do.
All right. So when you started the presentation and you just ended it again with grantor to non-grantor, and you know how important it is for those drafting provisions. So many of our advisors are also sell annuities. Yes. And one of the questions that came in was regarding the grantor to non-grantor trust toggle provision. And the question is, many financial advisors place annuities within irrevocable grantor trusts. Can you please discuss the impact of the switch or the toggle to non-grantor trust status on an annuity held by the trust?
Unfortunately, I can't do that quickly because Section 72 is really complicated and there's not one flavor of deferred annuity. There are dozens. So the simplified version is the IRS came out with a very helpful ruling within 12 months that said annuities held by trusts are good, very positive, but you still have to carefully look at that particular annuity and make sure that you don't trigger taxation. But I believe, based on the current IRS provision, that the vast majority of those will continue to retain their tax-deferred status even after the switch from grantor to non-grantor, but you cannot make that as a blanket rule. You have to look at each and every one.
Thank you. And then another question that came in goes to the heart of the planning and picking a trustee. So how do you pick a trustee that truly understands what their responsibilities are? And do you have any advice regarding that?
I am not in favor of trust companies or banks. I don't feel that they have the personal relationship. I'm not necessarily in favor of accountants, attorneys, financial advisors, just because they're very skilled in their area. I'm not sure that they're good trustees. So I will say my lecture to trustees are the most important thing is a family relationship or a caring about the family so that as trustee, you will give the attention that's needed, and you will lose sleep about whether grandchild Sally should or should not go to Cornell next year because she's only getting C's. That's the most important thing. And then the next part is the trustees are not supposed to do everything. They are supposed to hire who they need. So if I've got a person who is a caring family member or a friend who cares about the family and has the skill set to hire and fire lawyers, accountants, financial planners, advisors, stockbrokers, that's the most important, which is why I'm coming back to, why I'm coming back to what was the purpose of this slide? This purpose of the slide was John and Jane are their own trustees during their lifetime. The kids are the trustees in generation 2, and they need, I don't know, a decade, more than a decade of training. So it is my hope that after generation 2 has been trained for a decade on how to be a good trustee, they will be a good trustee.
Okay. Alan, we are 10 after the hour and we don't have any other questions. This was terrific. Thank you. If you would like the slides, please email Lisa Mitchell and she will be sure to get them to you. Again, this has been recorded, so it will be on the Agency One website. Also, if you would like information on how to reach out to Alan to work with you and a client, we will be happy to pass that information along as well. That information is also on the slide deck, so you will know how to reach him directly. As I mentioned in my introduction, this is our last webinar for 2021. On behalf of everyone at Agency One, I want to thank you for participating. If you are an Agency One 100 advisor, thank you for your friendship, your partnership, and the opportunity to be of service to you and your clients. We are beyond grateful. If you're not doing business with Agency One, please give us a chance and reach out to myself or my partner, Gonzalo Garcia. We would be honored to have the opportunity to get to know you and see if we can have a positive impact on your practice. We hope that everyone has a joyful and healthy holiday season and a happy new year. See everybody in 2022, and thank you.
Thank you, Kathy. Thank you, Agency One.
Take care.